Welcome to this week's current federal tax developments for the week of October the 1st, 2018. Current federal tax developments are brought to you this week, as always, by Kaplan Professional Education and by your state Society of CPAs. This week, we're going to have a few things we're going to look at going on. We're going to take a look at a Wall Street Journal report that tells us that the IRS is planning to issue guidance to resolve the question about business meals that we've had ever since the Tax Cuts and Jobs Act was first passed. The IRS issued guidance on the credit for paying employees for family medical leave under the FMLA leave rules. We also have a discussion of an issue related to moving expenses. The IRS clarified what happens this year if an employer reimburses what would have been deductible moving expenses in 2017 that were incurred in 2017 but weren't actually reimbursed to an employee until 2018. The IRS publishes this year's special per diem rates, which take effect on October 1st. So timely that we got those out. And we have an issue discussing an innocent spouse case involving an IRS agent who was able to convince the court and the IRS that he qualified as an innocent spouse. So with that, let's get started with this week's first story. And the first story actually comes from not a direct tax development from a source document, but a Wall Street Journal article. This article by Laura Saunders, which was titled, "Order the State, Client Meals Deductions Will Be Allowed," was published on the Wall Street Journal Online on September 28th. The article reports the IRS is going to issue guidance regarding the business meals question. As you may recall, under Section 274, the business meals rule tells us that generally, entertainment is no longer going to be deductible at all with the changes made in the Tax Cuts and Jobs Act. In the past, entertainment was 50% deductible in the same way that meals were 50% deductible. And so it didn't really matter whether a meal was considered entertainment or not. As I think I've mentioned here before, Gary McBride had a really interesting article in Tax Analyst earlier this year, in Tax Notes, I should say, for Tax Analyst, that discussed the history of 274 and outlined that all the way through the 1986 Tax Act, the committee reports make it very clear that Congress considered meals to be entertainment, which set up a big concern that if entertainment is no longer deductible and there's no special rule that says meals count, like there was, you go back to the very beginning of 274 with a casual meal exception, then we have a potential problem here because we're going to end up getting a full disallowance. Well, the Wall Street Journal report tells us that, in fact, the IRS plans to not deem those business meals entertainment. Now, I should rephrase that. All we know for sure is, or actually all we know for sure is nothing, because nothing's yet been officially confirmed by the IRS. But all we know really at this point, assuming that in fact we have information that is correct here from Laura, and I believe Laura does have a source that is, in the know, shall we say, about what the IRS is going to do here. We do know that at least some business meals will be considered to be deductible. Now, we don't know for sure where the dividing line would be or how it's going to work. And as we all know in taxes, details matter. But the Treasury had been hinting for a while that they were looking at some way to make business meals still deductible, at least in some situations, because it was fairly clear from the committee report that Congress still considered, business meals, whatever they might be, to be deductible, even if they didn't necessarily write the statute fully to make that clear. So it appears that the IRS has come up with a method they believe is acceptable that will not go against the basics of the law. So we'll just have to see how that works. The one problem we've got for the moment is we do not yet have the actual IRS guidance. It's not clear if, and Laura Saunders did not tell us, is this going to take the form of a notice, which could literally come out at any day? Is it going to be part of changes to regulations, which at this point would have to go through OMB, and we haven't seen anything yet go to OMB on this issue? Or will it be some other form of guidance? We're not sure. But it does appear, let's say, this probably makes it about 90% sure that we're going to get to business meals. There won't be a full disallowance. I leave the 10% because we just haven't seen the document yet. We need to see the document to understand what it is. But this likely is good news for our clients, and hopefully in the next week or two, we'll actually see the guidance so we can actually take a look at what the parameters of the allowed meals will be. Next up, this time we do have some IRS official guidance. This is Notice 2018-71, issued on September the 24th of 2018. And this deals with the credit that is allowed under Section 45S for paying employees on FMLA leave. Now, under this program, you have to pay your employees at least 50% of the wages they otherwise would get. You may remember FMLA says that you have to allow the employee to take up to 12 weeks off for certain medical events affecting the employee or affecting, certain relatives of the employee. But it does not require that that leave be paid. And that can cause us a problem because, a lot of employees really can't afford not to take, to take unpaid leave. So Congress is, at least for this year and next year, giving us a credit equal to a percentage. Now it starts at 25%. It goes up if the percentage of wages go up. So we end up getting more credit as we get above the limitations. So these rules are, they're useful, certainly helpful for clients, and it's something that we're going to want to keep track of. The ruling tells us a few things that we know. Number one, it's very clear there must be a written policy requirement or statement. So we need a written policy that tells us that employees are going to be, allowed to be paid this particular amount. And I said 25%. I really mean the credit is 12.5% at 50%. It eventually can increase to 25% if you pay enough. So, there'll be a partial subsidy, effectively like a quarter subsidy of the wages that you pay that you'll get back in taxes. Generally, that written policy must be in place before the employee goes on leave. You can't retroactively say, oh, yeah, we had that. I think we'll do it. In essence, Congress's concern was that we might wait, see that it was a highly compensated employee who had to go on this leave and suddenly adopt the policy and magically get rid of the policy as soon as a highly compensated employee, came back. So they're going to say, no, this policy has to be in place and has to be written. Now, you do not have to notify employees of this policy, but if you notify any employees of this policy, then you have to make sure notifications are non-discriminatory. Basically, you probably better notify people because otherwise, it's going to be pretty clear that certainly the highly compensated will know about this policy and have been informed about it. I think it's going to be very difficult to argue that you didn't tell them, in some way, shape, or form about this policy being available. And as soon as you make notice, you have to give notice to everybody. That's part of the deal. The other key issue to remember that this was one of those things that was put into law by Susan Collins, who wanted this involved in the law for her vote. A lot of other things, we have some special rules. First thing I should say is this program has to be written ahead of time, but because they just got this guidance out, for 2018, you are allowed to retroactively get the written document in place. So we're a little bit safe. And that's actually quite a big gift because this program only is good through 2019. Susan Collins negotiated. Remember, Susan had a couple of demands. She wanted this, and she wanted the 7.5% medical continued. Both of hers went for 2 years. So apparently, Susan, two years is Susan's time frame for a tax item in order for her to consider it okay for her to vote for it. So in any event, we have that now. The credit will end after next year. So if you want to establish this program, it's fine, but we won't know probably till the end of next year if Congress is going to actually extend this program or if they're just going to let it die after running for a couple of years. But if you are looking at putting together such a program, make sure you get this notice. This notice, which goes on for quite a while, has a lot of useful examples, details, and questions and answers that go over this program. Next up, more IRS guidance on employee benefits. Notice 2018-75, this was issued on September the 21st of 2018. This deals with the changes that were made to Section 132 by the Tax Cuts and Jobs Act. And specifically, we're talking about a timing issue here. Under the Tax Cuts and Jobs Act, employers who reimburse for moving expenses, and again, remember, we are already limited for what moving expenses could be reimbursed tax-free. But beginning in 2018, employers who reimburse for moving expenses will no longer be allowed to exclude that from the W-2 of the employees. The way the section was written, though, it was not clear if that cutoff was based on amounts paid in 18, or it was made about, or I should say amounts paid after 17, or whether it was only related for moves, and expenses incurred before the end of 2017. Well, it took a few months, and you're talking about nearly the end of September when the IRS finally came up with this. But the IRS has now said that if an employee incurred moving expenses in 2017 and the employer did not get around to reimbursing them until 2018, that is still excludable from the employee's W-2. So as long as the employee does that, we're good. So we can get that done. Now, the problem is a lot of these expenses were probably paid early in 2018, and employers, not being sure what to do, probably went ahead and withheld the taxes. This notice has information about how the employer can go to get those taxes back, how you return them to the employee, and all of the standard issues we're going to have here. Just be aware, though, if you have that problem, you have moving expenses that you reimbursed in 18, but the employee moved in 17, and you didn't get them reimbursed by the end of the year because you didn't know you had this deadline until basically December the 22nd, you might be able to, you maybe should be going back and looking at amending your payroll tax reports and trying to get this information put together. So, unique issue. Next up, more, as I said, Employee Benefits Week is here. We have this time Notice 2018-77 issued on September the 26th. This notice deals with the IRS's special per diem rates for travel. And, we have these particular issues. Now, as you may be aware, the fiscal year for the federal government begins on October 1st. So per diem rates are updated on October 1st. Those using the general per diem rates, when you go get those from the GSA site, those rates also change on October the 1st. So be aware, if you actually do make your changes at that date, you are allowed to keep using the same one all year, in which case they don't have to change it. You just have the one coming for January. But if you do change with the fiscal year, which, for instance, when I'm reimbursed for the work I do, I am reimbursed based on the fiscal year, based on the actual federal government fiscal year, so it'll be the October 1st date, these rates are going to change. Now, if you're in the transportation industry, that special rate is $66 for transportation and for travel inside the continental United States, and $71 per day for travel outside the continental United States. So those particular rules in transportation, we now have the numbers, they have been published. The incidentals rate stays at $5. So if on the unlikely chance that you are reimbursing, let's say you're paying directly for the food, you're paying directly for the hotel, but you're going to reimburse incidentals on their own, you can give them $5 a day and exclude and not have to report that in the W-2. The incidental number is the $5 amount. Again, I don't know of many employers that use only the incidental number, but you're allowed to if you want to. Now, the IRS, as we've talked about before, tried to get rid of the high-low method a number of years ago, and everybody squawked. So in 2014, they tried to get rid of it. It didn't work. So the high-low method is still around, and that means we have new high-low rates. The high rate for meals and incidentals for the year beginning October 1st, 2018 through September 30th, 2019 will be $71, with the low rate being $60. These are both $3 increases over what we had the prior year. So those high-low rates are in place. Obviously, if you actually do follow the federal government's fiscal year, these are numbers you'll be working with as well. Don't forget to use the right table from the General Services Administration if you are using the standard per diem rates, where you look at the area and get a specific per diem for the area rather than using the high-low rates in this table. And those all starting this week. So, make sure you've got that up to date. If you are doing it on the calendar year, just remember that the calendar year, you now have all the numbers. The programming for next year could be started at this point. Finally, this week, we're going to talk about a tax court case. This particular case is the case of Merlo versus Commissioner. This is Tax Court Summary Opinion 2018-47, issued on September the 24th. This was the case of an IRS agent who was divorcing his spouse. The spouse and he, what happened was they ended up, finishing up 2011, and they applied for an extension to file a 2011 return. Shortly after applying for the extension, this agent's spouse moved out, and they filed for divorce. And apparently they weren't communicating really well during this time period. In fact, the court tells us almost all communication after the spouse moved out was basically through their attorneys. There was very little done personally. Things got delayed. So we're coming up here racing now, which is kind of interesting in this case, for the October 15th deadline for the year in question. And what happened was the IRS agent, not surprisingly, was going to prepare the tax return. You might think, well, that kind of makes sense, right? The agent hopefully knows a bit more about handling these things. But it turned out that they had wage income for the year, and the agent knew his income, right? Mr. Merlo did. It was $106,863 in wages that were paid. So that was known. He knew his wages, but he didn't have his spouse's wages. He didn't have the spouse's W-2. Now, apparently he had written down what her total wages were at some point, but didn't actually have the W-2s. So it ends up happening as they're racing to meet the October 15th deadline. October 12th, the agent finally breaks down, gets a hold of the ex-spouse, or soon-to-be ex-spouse, and sent her an email saying, look, we really need, right? Well, he sent an email to his counsel to forward to his spouse. Now, this is on the 12th. We don't know it got to her on the 12th, but hopefully she did that. Got to her saying, I really need the W-2, right? We are going to require W-2. We need a draft of the return. He prepared the return based on total wages for her that were correct, right? In this case, he had the total wages down there of essentially $5,811 for her. Now, in reality, and that was on the spreadsheet and on the return. In reality, her wages were $1,182 paid by Ethan Allen, but then she had $4,629 in disability income paid by Prudential. The spouse, when getting a copy of the return, made various suggestions about the return and how it should be handled. Okay, he had the worksheet. We were in that particular place. Now, finally, he prepares a draft of their Michigan return. Early on the morning of October 15th, the final day for filing the return. So we're at the very end of the filing period of the return. The spouse who had not provided the W-2s came in and said, wait, you got this wrong. My Ethan Allen wages were only basically the smaller, were only, much less than what you have on this statement. So in fact, she told him that her Ethan Allen wages for the year were only $1,182. He took that as meaning that the return was in error and her wages were overstated. So he reduced her wages down to that, therefore left off the $4,629 that had come from Prudential. Now, he emailed her a revised draft with her to review at 7:20 a.m. that morning. Eventually, she accepted that return, and the return was delivered to her. She was to attach her W-2s to the return, apparently, which she did. And then everything's fine, except, of course, the IRS will notice this problem, and they did. So the IRS came up and said, Guy, this doesn't agree. He unhelpfully initially responded that the W-2 wages that they found there were for some other person with a different EIN. The IRS eventually determined that some other person was the soon-to-be ex-spouse. We were filing a joint return on that return. The IRS took that to mean we're asking for innocent spouse relief. And so they started to look at whether or not it would be justified to give him innocent spouse relief under Section 6015C. Now, 6015C generally, for innocent spouse relief, allows you, if you're divorced, if the item of understatement is not yours, and you did not know about it or didn't have reason to know about that amount of income before the return was filed, then you're allowed to essentially be treated as the innocent spouse, and all the liability goes to the other spouse on the balance due. Not surprisingly, the taxpayer's spouse disagreed that he was an innocent spouse because she, of course, didn't want to be the sole one on the hook for the taxes. But the IRS said, yeah, we agree. It's him saying, look, she got a copy of the return. She had a copy of the Michigan return. She was asked for the W-2. She didn't provide them. She knew what those two W-2s added up to. And she chose only to say, not that my wages are, that you should have listed my wages as this much from Ethan Allen and this much from Prudential. She said, no, my wages from Ethan Allen were this, which gave a reasonable person obviously could have interpreted that. In fact, probably normally would have interpreted that to mean that her wages were too high on the return, since the only title there was Ethan Allen for the total. And therefore, the reduction in wages was essentially at her request. And therefore, he did not know that she had that second W-2 because she had it. The tax court agreed with the IRS in this case. The tax court said, you know what? The IRS is right about this. She knew she had two W-2s. She responded to him in a way that it was totally reasonable for him to come to the conclusion that, in fact, the wages were overstated on the return he had sent her. Because, the way she phrased it back, she did not say that, oh, by the way, guys, our W-2 is wrong, or in essence that you got this wrong. I should say, she didn't say that, no, there's two W-2s. And so even though she may not have literally said my wages are too high, she strongly implied it. Because her way of phrasing that led to the problem. And she had another shot to look at the return, and she didn't say anything. The tax court decided that really it was her mistake that led to the problem. So because of that, they agreed to allow the IRS agent to obtain innocent spouse relief. It's fall, and we're getting here to the very end of tax season. I guess, well, it's tough to say it's fall here in Phoenix because we keep having these 100-plus degree days. But I was in Pierre, South Dakota this week. Definitely noticed there, the temperatures were, it wasn't really fall for Pierre, South Dakota either. It was actually pretty nice, relatively warm. But still, much nicer temperatures, highs in the high 70s, kind of nice time, looked good. But we are in fall, and certainly in a couple of weeks, a lot of you will notice it's really fall. And it's time to start considering your sign-ups for your CPE courses for the coming, for this short season. We all know that we love CPE. We love getting our credits from October 15th to December 15th. Be sure to check with your state society for courses they're offering. Again, I'm going to be doing an update of new Section 199 and other provisions that were business related on the Tax Cuts and Jobs Act. I'll be presenting that in Boise, Idaho, come the end of this month on the, in that, and I'll also be doing another day on multi-state taxation of business, the whole Quill mess, and where we stand on the sales taxes, Quill, and other, and what Quill does, and I shouldn't say Quill, but Wayfair, and also what Wayfair does for state income tax issues, which is a whole nother long discussion. So be sure to sign up for courses. I'm going to be doing those. I'll be doing that one on the qualified business income issue also in Phoenix the day before Thanksgiving. I'll be at the at the Pacific Tax Conference in Portland, Oregon, early coming up. We'll be talking about TCJA issues other than 199 Cap A. What's been happening there this year. I'm also going to be presenting in Tucson with a tax update in November. Got lots of things happening. Oh, yes. And at the Minnesota Tax Conference, I'll be doing 4 sessions there on the first day of that conference. So I'm going to be around, hopefully see some of you guys around at those places this year. This has been the current federal tax developments for this week. Be sure to catch our regular updates at www.currentfederaltaxdevelopments.com. You can send any questions or comments to my email address, edzollers@currentfederaltaxdevelopments.com. I'll try to get back to them. I'm going to be honest, this is end of tax season for me too, and so I'll be rushing around a bit. So it may not be quite as responsive. I'm going to hope to get the podcast out for both weeks coming up, but don't be surprised if things may be pushed or a little short, like this week's a little bit shorter. because of all the rush going on. I also try to follow discussions in various places on the internet. I follow along somewhat on the subreddit on reddit.com/r/taxpros. I also pay attention to discussion groups for the Arizona Society of CPAs, New Jersey Society of CPAs, and pay attention on Tax Talk run by Cal CPA. So let's pay attention. Maybe we'll get the entertainment guidance this week. We're also still waiting on the opportunity credit guidance that we know now should be coming out here in the next few days. In fact, Treasury Secretary promised it here shortly this week. So keep an eye on that. There's going to be a lot of things happening, a lot of things to keep up on. And just be sure to come back and check back in here next week when we'll talk about what's been happening here in the area of federal taxes.